What's going on, everybody? Welcome back to the channel. I appreciate you stopping by, spending a few minutes of your time here with me tonight. Tonight, I want to go over some very basic ideas with you, all right? And then tie it into Stacey's work, Stacey's strategy, okay? Now, this that I'm about to go over you with, it's something that you can go look at on your own charts right after this video, okay? But this is a fact of the market. It's a non-negotiable, okay? You cannot debate this that I'm about to tell you. And there are certain things that are like that about the market. There are certain foundational facts of the market. And if you can understand these facts, okay, these are the foundational building blocks to a solid trading strategy, okay? You could take these basic market facts and from there build upon that and create a strategy, a working strategy for yourself from scratch, okay? Now, what I want to talk to you about specifically are wicks on candles and what those represent, all right? And then we're going to, talk about using this information in conjunction with Stacey's work. Now, the fact of the market that I'm telling you about today is the fact that 98% of the candles on your chart, no matter what time frame you're looking at, will have wicks on either one or both sides. Okay? Now those wicks, and this is so basic, we take it for granted, okay? Don't skip this video. This is something you need to understand about the market and how the market moves, all right? These wicks, upper wicks, right? These represent the high of whatever time frame. So let's imagine that these candles we're looking at on the screen right now are daily candles. Each candle represents an entire day's worth of price action, okay? So these upper wicks are the high of the day. These lower wicks are the low of the day. And that's the same whether you're looking at a candle with a lower close than the open or a candle with a higher close than the open, okay? The upper wicks are always the high of the day. The lower wicks are always the low of the day. Now, another way of explaining this, okay? Another way of saying this, so the next level of meaning here means that this wick, okay, is not just the high of that day. That wick represents a portion of intraday price action that traded above the opening price of that day, okay? So here's our open, and at some point, the market traded above that open before ultimately giving a lower close on the day, okay? Just like this candle, okay? We open here at the upper body of this candle, and at some point, the market trades above that opening price before ultimately giving a lower close, right? And over here on these bullish candles, you can see we open down here at the bottom of the candle, and at some point we trade below that open before giving a higher close. Same thing here. We open right here, and at some point we trade below that opening price before giving a higher close by the end of the day, all right? So that's what those wicks represent. Now, what this really means to me about market structure and how the market moves, all right, as long as we understand this and we know that 98% of the candles have a wick on one or both sides, what that means is that if we have a day that closes lower, right, and then we expect the next day to also give a lower close than the open, we can expect this market to trade back into the previous day's high and low range before closing lower, okay? Or if we have a green day and we're expecting another green day, then we can expect this market to trade down back into the previous day's high and low range before shifting and giving that higher close, right? So this also means that on a day where we are expecting a lower close, if we can sell this market anywhere above the opening price, we are selling it at a premium price, okay? And any day that we're expecting a higher close than the open, anywhere we can buy that is below the opening price of that day is buying it at a discounted price, okay? You're getting in at a good price. Does that make sense? On a day that's going to give a higher close, okay? So we are expecting the market to close higher than where it opened. So if we can buy below where it opens, we're getting a good price. Does that make sense? Okay. And this is just how the market moves. All right. And we can use this information in accordance with Stacey's strategy. All right. Now, let's just look at this, you know, a little bit differently. So here I've just drawn out two bearish candles followed by two bullish candles. We have 4 days of price action that we are looking at. Okay. Here's our daily candles and here's our 15-minute charts. All right. Now, you can see this first day opens, trades higher than the open, gives a lower close, but also trades a little bit below the close. So we open right here, we trade above that opening price. The market shifts, goes lower, 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 and then pulls back and closes just above the low of the day, creating that bottom wick, right? Then the next day opens, trades back into that previous day's range, and then gives a lower close, okay? So we open, trade above the opening price, back into the previous day's high and low range. The market shifts, goes lower, and closes again just above the low of the day, right? And then we have our first green day. Let's say we're at the, near the low of the month. We're at the low of the week, okay? And this is Monday, Tuesday, Wednesday. We have our first green day, okay? The market opens, trades below that opening price, lower than the previous day. Okay, that's that wick right there. Okay, and then goes higher, giving a higher close. We have a very small wick. It barely pulls back and closes below the high of the day. All right, there's our first green day signal. So the next day, we're expecting a higher close. All right, we're expecting that first green day follow through trade from the low of the week. All right, so the market opens, trades below the opening price back into the previous day's high and low range, all right, back to the open, almost back to the opening price of the previous day, all right? And I know that sounds different. We're not saying closing price, all right? But if you wanted to, it's Tuesday's closing price, okay? So we're trading back to Tuesday's closing price, okay, before shifting and trading higher, giving that higher close. So anywhere we can buy this market below the opening price, we're getting in at a good price if we indeed get that higher close on the day. And you can see this market on Thursday closes at the extreme, so there is no wick on the top of that candle, right? And this is just how the market moves, right? In that stair-stepping type of pattern. We go down, go up, back into that range, go down, okay? Then here we go up, and then we come down back into that range before going up. So there's this constant, you know, impulsive move and then a correction, impulsive move, then a correction, impulsive move and a correction. A lot of the times we're trading back into the previous day's range before continuing in the originally intended direction, okay? This alone is powerful stuff. It's just so simple. We take it for granted, we forget about it, and we don't understand the importance of it, okay? And then you'll get stuck. And at some point when you feel stuck, you start to feel like you need to go out and learn a bunch of new shit. But really what you need to do is go back to the market basics, these foundational facts of the market, because there is something most likely that you are missing that is super simple that you've taken for granted and shoved it to the side, okay? Now, let's talk about Stacey's work, all right? And I'm going to try to keep this as simple as possible. Okay. We're not even going to be talking about 3-day setups, signal days, or none of that. We're just going to be talking about what we're looking for on the day of the trade. Okay. Now, I've said this before on this channel, all right? But it is my opinion, and this is just my opinion only, okay? It's my opinion that 80% of the price action on your charts is completely useless when it comes to actually entering trades, okay? And this is that 80% here. This is our two blue lines that Stacey loves to talk about, okay? Those two blue lines represent the previous day's high and the previous day's low. Anywhere inside of the previous day's high and low range is a no trade zone. This is the inside. This is what Stacey refers to as the matrix, fugazi, the diddle in the middle, all of that, okay? This is the no trade zone. Now, we will monitor what's going on inside of this zone to help us plan our future trades, but we will not be entering trades inside of this range, okay? Now, there are exceptions to this rule, okay? There are always exceptions to the rule, and we will go over that in this video as well. But for right now, you need to understand that we do not trade inside of this range, okay? This is the 20% of price action on your charts that actually matters when it comes to entering the market, all right? Now, the previous day's high and previous day's low, you can think of these levels, right, as the extremes of the daily range, right? This is the peripheral of the market or the edge of the market, okay? These are the edges of the range, the edges of the market. And it is at these levels where you will find your edge, okay? You hear traders talking about that online all the time, that you need an edge. Well, this is where and how you're going to find your edge. This here is where you are going to find your highest probability trades, okay? This is where you're going to find your asymmetrical risk to reward, okay? Now, we already know that we trade the New York session opening timing window, okay? Which is from 8 o'clock in the morning to 11 o'clock in the morning, unless we're talking about indexes. Then we're waiting for 9:30, okay? So the timing window is even more strict from 9:30 to 11 in the morning, New York time, okay? So we only want to trade when one of these levels is triggered in that timing window, okay? That's the only time that we're gonna be looking at a specific market to trade it potentially, okay? Is when we have triggered either the previous day's high or the previous day's low in that timing window. If you can do this, if you can stick to these two rules, you are going to immediately increase your consistency in your trading and immediately simplify your trading. And the more simple you can make your process, all right, the more consistent you're going to be, which is exactly what we're looking for, okay? You're going to instantly increase your win rate, okay? I can't guarantee that, okay, but you should. If you're following just those two instructions, this is going to immediately help you with certain issues like over trading, okay, because you're only trading when one of these levels is hit in your timing window. That's going to denoise your trading process greatly, okay? Now that we have that understood, hopefully, right? This is what we're looking for. This is all we're looking for. Now, me, I'm short biased and I like to trade reversals. So this is specifically what I am looking for. And we will look at different examples, okay? But this is sort of what I'm looking for. I don't really like to trade continuation trades where we break out of the previous day's high, pull back on top of that high, and then continue to go higher, okay? I look for specifically reversal trades. I like to trade pump and dump type of trades, and I'm trading the backside of the move only, right? So this is a type of scenario that can happen, okay? We open here, we trade above the open, We break out of the previous day's high in the Tokyo London gap time, okay? Coil sideways through London into the New York Open. When New York opens, we spike up one more time, taking out the high of the current day, putting in a new high of the current day before this market reverses, okay, and trades lower, ultimately giving us a lower close on the day. All right. Now you can see this is an example where we break out earlier in the day. And here is an example when we break out in the New York session, okay? So this market is pumping up from the Tokyo lows, pumping up through London. New York opens, we pump up through the previous day's high, immediately trade back inside, pump up one more time back into that level, all right? Before putting a lower low on the inside in, right? Front side, back side, we pump, coil, dump. There's our entry somewhere in here, okay? This is our standard conservative entry. A more aggressive entry would be up here when this middle structure of this M is broken, right? So that is all we're looking for, bro. That's it. That's all you're looking for. You don't even necessarily need to track 3-day setups or signal days, okay? You just need to know what you're looking for, what it looks like, okay? The levels that are involved, the times that are involved. And here is a buy low scenario, so a dump and pump instead of a pump and dump, okay? Still the type of reversal trade that I'm talking about, all right? So we open, dump down below the open, we dump down through Tokyo, dump down through London, coil sideways into the New York Open. New York opens, we dump down one more time, taking out the low of the current day, and then start to pump up, okay? Go parabolic as New York opens to the upside, giving that higher close, all right? This is all we're looking for, okay? Set an alert on your chart at this level, at the previous day's low. Wait for that level to be triggered in your session timing window, all right? Wait. And after that, all you're doing is waiting for your entry criteria to be met, all right? Now, here are the exceptions for the rule, and you're going to see this a lot. And sometimes you just have to use your common sense, right? We're not always going to go and take out the previous day's high, right? If we're in a downtrend on the daily time frame, right? Not every day is going to go up and break the previous day's high and then go lower, okay? It doesn't need to do that. It just needs to go back into that range, okay? And back perhaps into that level. It doesn't have to go all the way to the level or through the level. It can just go back into the level. The level is not a specific price point, okay? In one perspective, in one way of looking at it, it is a specific price point, okay? But it is also an area or a zone, okay? So as long as we're trading back in there, okay? So let's just say the previous day gave us a lower close than the open. So we're expecting the next day to also give a lower close than the open. So the market opens, starts trading, pumping up above where it opened, okay? Above the previous day's closing price, we pump up, okay? We don't break out of that high, but we coil sideways, okay? Going into the New York session, pump up one more time, take out the high of the current day before reversing and going back below the previous day's closing price and ultimately giving us our lower close on the day. All right. Now you can see this one has like this long coil here, but we could have something like this where we're just pumping up continuously, pump up through Tokyo, pump up through London, sideways through the gap time. New York opens, we pump up one more time without taking out the previous day's high, okay? And then give a lower close, all right? So anywhere you can sell this market above the previous day's closing price, you're getting in at a good price, all right? And again, all of this price movement above the previous day's closing price is the upper wick, right? That's that upper wick, that portion of intraday price action that trades above the previous day's closing price before ultimately giving a lower close, okay? So we are opening, we're trading back into the previous day's range before continuing the downward momentum, all right? And this is basically what we're looking at, okay? Let's say the previous day gave us a lower close than the open. Here's the previous day's high. Here's the previous day's low. We're expecting another lower close, okay? So the market opens, trades a little lower, but then pumps up above closing price in Tokyo, pumps up again in London, and then pumps up one more time in New York before reversing and heading lower. You can see this sort of head and shoulders type of pattern, right? 1, 2, 3 sessions, 3 pushes against yesterday's trend, okay? Yesterday's downtrend. We're trading back into the previous day's range before reversing, okay? And here's an example of a buy low opportunity, okay? So let's say that the previous day gave us a higher close, okay? This is our first green day, the previous day, perhaps, okay? So what we are looking for is on the current day for the market to trade back into the previous day's high and low range before reversing and giving that higher close. So you see the market opens, we start to dump down below the previous day's closing price. We dump down in Tokyo, dump down in London, right? And then pump up going into the New York session. New York coils sideways, dumps down into those London lows for a final time, and then goes parabolic with the New York open, okay? And here's your potential entries into that market, okay? Aggressive and conservative, right? Anywhere we can get in below that closing price, you're getting an especially good price, okay? Now, I hope that this makes sense for you, right? This is all we're doing. This is all we're looking for, okay? Once you've done your due diligence, okay, and you have a bullish bias, okay, then you're looking for the market to trade back into the previous day's high and low range before reversing and going higher, right? Or the opposite, okay? If you're expecting a lower close on the day, that's the bias you have. That's the trade thesis that you've come up with based on, you looking at the charts, tracking your setup, or however you want to do it. And like I said, you don't even have to do that. All you need to know, the previous day was red, so we're looking for the next day to also be red. It could be that simple. And you're looking for it to trade back into the previous day's range before going lower, all right? This is about as simple as I can explain this stuff, what we're looking for on the day, all right? A pump and dump or a dump and pump. Every candle has wicks on it. Go back on your charts and on the daily charts, inspect the wicks of those daily candles and then zoom in on your 15-minute or your 30-minute chart and see what those wicks actually represent, which is that portion of intraday price action that trades below or above the previous day's closing price, depending on what direction we're going to close in, okay? Anyway, man, I appreciate every single one of y'all. Let me know how you like this video, all right? And until next time, I hope you continue to free your mind.